Hey guys, so in today's video we are going to be going over 5 stocks to buy in August of 2017. And I'm sorry that this video is out a bit later than I normally make them. It is partway into August already, and I normally try and get the videos done before the month that I'm making the recommendations, but I've been very busy over the last few weeks. And so I just haven't been able to get the video made. Before I get into the video, if you are interested in any of these stocks more, I will have in-depth analysis videos linked in the description. So in this video, I'm just going over the more brief reasons to buy them, and then I will make in-depth analysis videos on them, which will focus more on just that one stock. And I'll also put cards to those in the top right as the video goes on. And so if you're new to my channel, I make stock market and investing videos, so consider subscribing, and let's get right into the video. I was going to recommend AT&T and Verizon, and I was going to try and get the video made 2 weeks ago, but now that AT&T and Verizon have both skyrocketed post-earnings, I don't think they're quite as attractive as they were, so I'm not going to recommend them. I think they're interesting plays to look into due to net neutrality potentially being rolled back, which would benefit them, as well as potential corporate tax cuts would have a large benefit to them because they both are paying high effective tax rates. But like I said, after the recent jump, I'm not going to be recommending them, but I still think they're worth watching. So to start, the first stock that I am recommending is Exxon Mobil. Exxon Mobil is a very strong integrated oil company. They are the largest oil company in the world, and their ticker symbol is XOM. And Exxon Mobil is a great company that has been hit hard by the low oil prices recently. Their dividend is nearing 4%, and they're currently trading under $80 per share. And so I think this is a very attractive entry point at under $80 per share. And so the reason I like Exxon Mobil is because, first off, they are integrated, which means they are stable through all oil price environments. They are currently profitable even though oil prices are at 50, where an upstream producer would likely be struggling to turn a profit right now. ExxonMobil is not struggling too much with turning a profit, though their profit is a lot lower than it used to be. And I also see ExxonMobil as a company that has a lot of good upside if oil prices are to go up. They are producing 3.9 million barrels of oil per day, so just think what a $5 change in oil prices would do to the money that they are bringing in. ExxonMobil also plans to start rolling out gas stations in Mexico, which is another good area for growth for them. So all in all, I think it's a great company that is very stable. They've been raising their dividend every year for the past 35 years, which is very rare to see in a company that relies so heavily on commodities. But they are a well-managed company that plans very far into the future with their acquisitions and what they're doing with their company. They're currently even working on algae that produces biofuel, which is something that likely won't be around for 20 years or more, but they are putting some time and research into it now, which again shows that they're very committed to the long-term success of their company. So the second stock that I'm recommending for August of 2017 is Omega Healthcare Investors. The symbol for that is OHI. And Omega Healthcare Investors operates senior nursing facilities, so that's assisted living homes and nursing homes, and pretty much they are the REIT that rents the buildings to the people who run them. So they own the buildings that the senior nursing facilities use, and then they receive rent from the companies that use the buildings. So like I said, they're a REIT, and they are currently very attractive because they have an 8.25% dividend, and this is covered by their adjusted funds from operation. They have around an 80% payout ratio. And so like I said, the dividend is pretty sustainable, which is definitely good to see, especially with such a high dividend. The concern with them has come from potential Medicaid cuts. I guess it's not really cuts, but it would be a decrease in future funding to Medicaid, which would definitely hurt them slightly. But I think that they will definitely be able to overcome this even if there are cuts to Medicaid, and they remain a strong player in the healthcare REIT industry, and so I think that that is good. They're also trading at about 9 times funds from operation, which is very cheap for their company, so that is another great thing to see with them. And then also the main thing that they have going for them is the strong demographic shift. The population is aging rapidly. The baby boomers are starting to get old, and this means that a lot of people will need to be in assisted living facilities and nursing homes. And so I don't think that the government is going to just leave a bunch of old people out on the streets. The older people vote at a much higher rate than anyone else, and so politicians love to cater to them, which means that they will continue to fund Medicaid, And so I don't think there will be a problem with Medicaid funding. I think that this demographic shift will definitely benefit Omega Healthcare investors. And so I think they're positioned well to profit significantly from the aging population. And then the final concern is that during their last conference call, they disclosed that 2 of their tenants are struggling and are behind on rent. They did not seem overly concerned with this, and they said that they did have personal guarantees, so they would be able to get the money if those people don't pay them the rent that they are behind. But this is definitely something that you should look into before you invest in them, and you should definitely listen to the call and check for yourself whether you think this investment is too risky for you. And then the third stock that I think is a good buy in August of 2017 is Molson Coors Brewing Company. The symbol for them is TAP. They are a beer brewing company that has many strong brands like Coors Light, Miller's Light, and many more. I will put a list of their brands on the screen so that you can see it. And they're positioned well because they are a consumer staples company, which is good to see. I think that since we've been in an expansionary period for 9 years, it is definitely not a bad idea to shift some of your portfolio into consumer staples companies. I don't think people are going to stop drinking beer during a recession, and that is why it is a consumer staples company. So they likely won't be too affected if we have a downturn, or at least they won't be as affected as other stocks. They're positioned well because they are a lower cost beer producer, so they have a lot of cheap brands, and so people aren't going to think too much about buying them because it's not very expensive. They also have a low payout ratio sitting at around 20%, which means that they will be able to continue raising their dividend, which is always great to see. And then additionally, they have a 15.7 forward price to earnings, which is great to see for a consumer staples company. This is much lower than that industry. And then the fourth stock that I think is a good buy in August of 2017 is Delta Airlines. The symbol for them is DAL. So I personally think Delta Airlines is the best airline around. They are well managed, they're a solid company, and they're a large airline. However, they are trading at a discount to the airline sector. Delta has a price to earnings of around 9.8, and the industry average is around 11. So right there you have a solid company trading at a discount to their industry, which is good to see. Delta has also pulled back recently and is down around 12%, which I think creates an attractive buying opportunity. And lower oil prices will definitely benefit Delta. That will mean that they have a lot lower fuel expenses. And so if you were to buy Exxon Mobil and Delta, that would offer you some automatic diversification because Exxon Mobil would benefit from higher oil prices, but Delta would benefit from lower oil prices. So your portfolio would automatically be less exposed to large swings in oil prices. I additionally think that Delta is good because they recently announced that they are raising the dividend by 50%. And so their forward yield is about 2.5%. This shows that the company is very strong. A company doesn't raise their dividend 50% unless they are very confident in their future. A dividend cut is definitely a very bad thing for a company. It will cause people to sell the stock. People will think that the stock is not safe anymore. And so companies tend to take large dividend raises very seriously and only will raise their dividend by that much if they are really confident that they'll be able to continue funding the dividend. And so I think that that again shows that Delta is in a strong financial position. And this is definitely good because they are an airline, so they are a cyclical company. However, I think that they will definitely be able to survive the next recession. And so cyclical companies do tend to trade at lower price to earnings ratios. But if Delta were to survive the next recession, people would view it as a more safe stock and assign a more premium price to earnings to it. So that will definitely be another thing that I think will happen to Delta maybe in 10 years. But in the short term, I think that they are poised to benefit from a lower price to earnings than their industry and low oil prices. The fifth stock that I think is a buy in August of 2017 is Disney. The symbol for them is DIS. And I think Disney is a good buy because they are a strong company with some of the most recognizable brands of anyone. They have Star Wars, they have Marvel, they have almost every strong brand in the entertainment industry. They also own ESPN and ABC, so they have quite a few things going for them. But recently they've been struggling. Since 2015 they've been flat, and they recently struggled with earnings. In their most recent report they beat earnings but missed revenue and showed continuing struggles with ESPN, and this got the stock sold off quite a bit. I did buy some at $100.75 per share. I think they're currently trading at around $102 per share, but I still think that they're a very solid buy at $102 per share. And so the reason I think that they're a strong buy is because in 2019 they are going to be moving away from Netflix and starting their own streaming platform. This is definitely great for them because Disney has so many strong movies and brands that will be, and ESPN that will all be featured on their own streaming platform, which means that they will be able to profit from owning the streaming platform and the content versus just profit from owning the content and then having their content on Netflix. So this is a good move. Disney should have made this move a long time ago, but better late than never, and I'm happy to see them making this move now. So like I said, Disney is kind of in transition. ESPN has been struggling a lot recently, and their most recent quarter, their studio revenue, that is from movies, didn't perform that well, but in the conference call, they discussed that this was due to not having a very strong movie lineup this most recent quarter, but that they have very strong movies coming out in the future, and I tend to agree with them on that, so I think that that's not a huge problem. I think that ESPN will continue to struggle for a bit, but I'm hoping that they can get this solved by having their own streaming platform. They also showed super strong growth in their parks, hotels, and cruise lines. This is good to see. This part of their business is performing great. They're expanding it quickly. They have new hotels and resorts opening up. They're working on 3 new cruise ships. So they have quite a few things going for them there. And then as they transition the rest of their business, I think that in 5 years, they will definitely have performed very well. Over the next year, they might be flat because they're in transition, but long term, I think they are very, very strong. And then I also wanted to do some honorable mentions for stocks that I think are worth watching, but I'm not going to recommend. So I think AT&T and Verizon, like I said at the beginning of the video, those 2 are worth watching. I also think Shire PLC, which has the symbol SHPG, is worth watching. I recommended them in every single other stock recommendation video, but I'm not recommending them again just because I wanted to move on to some newer picks. This doesn't mean that I don't think that they are still a buy. I think they're still a good stock to buy, and they're very undervalued, so I think it's worth checking them out as well. Like last month, links to the in-depth analysis videos on all of these companies will be in the description. So if you're interested in a more in-depth analysis of any of the companies, check that out. Thank you for watching. Please remember to like and subscribe.